Welcome to the Financial Planning for Canadian Business Owners podcast. You will hear about industry insights with award-winning financial planner and entrepreneur Jason Pereira. Through the interviews with different experts with their stories and advice, you will learn how you can navigate the challenges of being an entrepreneur, plan for success, and make the most of your business and life. And now, your host, Jason Pereira.
Hello and welcome. Today on the show, I have a repeat guest, Aaron Hector, who's come on to talk about Canada's newest registered account, the FHSA, the First Home Savings Account. And we'll get into how it works and why I'm not a fan shortly. And with that, here's my interview with Aaron. Aaron, thanks for taking the time.
Hey, Jason. Thanks for having me.
My pleasure. Now, you've been here before, but for those who didn't listen to your masterclass on older security, tell us a little about yourself and what it is you do.
Sure. So I am a financial planner. I work with a firm called CWB Wealth. I work primarily with individual clients and family direct client relationships, I guess you could say, in a financial planning, estate planning, tax prep, that kind of capacity. And then our firm also provides other services to kind of overlay the total offering to our clients.
Excellent. So brought you on today to talk about the newest registered account that we have, even though there's not an R in front of it. Anything that's registered with the government's a registered account, the First Home Savings Account. So let's start off by talking about what it is.
Sure. So the FHSA is a home that's really designed to help people save for buying their first house. So it pulls characteristics from both an RRSP and a TFSA, essentially. So when you make contributions, you get a tax deduction on the front end, just like an RRSP. Following that, you can invest the money for up to 15 years, but up until the point you buy your home. All the investment return through that time period, through the holding period, is totally tax-free. And if you do ultimately buy a house, it comes out as a withdrawal tax-free as well. So you can kind of see how it operates both as an RRSP and a tax-free savings account. And there's certain restrictions on how much you can put in. So you can put up to $40,000 in your lifetime, but you can only put $8,000 per year.
All right, so $8,000 a year gets deducted, gross tax sheltered, comes out tax-free. It's funny, when they named this thing the FHSA, I was like, they pretty much, it's almost identical to the HSA in the US, the Health Savings Account. It's deductible and it's tax-free, only they use it for healthcare, not for housing. And of course, they threw an 8.5 in front of it. So it's any American listeners, it is very similar to FHSA. So an HSA, except for the fact that we get our healthcare paid for, you don't. And housing is a bigger concern here than it is there. If you don't believe me, take a look at a chart. Crazy. Anyway, so basically that's the crux of it. Now, I will take a diatribe here and say this is my least favorite account ever, because the same thing could have been accomplished by expanding the RSP limit and changing the home buyer's plan. And we would have no need for the administration of a new account. And also, accessibility and affordability are two separate things. This does nothing for affordability. It does help accessibility, but that will potentially just add more pressure to pricing. Anyway, that's my diatribe. So let's talk about the things to be aware of with this, right? So this is like a TFSA RSP, investing's the same, no other catches there, right?
Yeah. Same investment options within the account. That's true.
Now, one of the things that always happens when these new accounts come out is that invariably people don't understand the rules, open them when they shouldn't, fund them the ways they shouldn't. Let's talk about what happens and what people need to know about so that they don't go sideways on this or go wrong on this, and what the penalties are. So first off, who's eligible for this?
Sure. So you need to be a Canadian resident, not a Canadian citizen, Canadian resident, which is important, not to confuse those. You have to be at least 18 years old. You can't be older than 71. So the timeline is really the same timeline as an RSP, 18 to 71. And you need to be deemed a first-time home buyer, which is the definition on that isn't really that you've never owned a home. It means that in the current year or in the prior 4 years, you haven't owned a home that you're actually living in. So if you're a renter, but you also own a rental property, that's actually fine. It depends on where you live. And I guess one more thing on that, you get captured also if your spouse or common law partner owns a property that you're living in as well. So it doesn't have to be your direct ownership. It could be a connected ownership in that way.
Yeah, that was a loophole in the original legislation, is it basically looked like spouses who weren't untitled were going to be able to use this for a second home, right?
Right.
But luckily, depending on how you feel about it, it's basically, it's not a case anymore. So bottom line is that if you don't own a home or your spouse doesn't own a home, then you are eligible for this as long as a Canadian resident. Keep that in mind. I once had a non-resident client contributing to a TFSA. That did not go over well with CRM. So you got to be living here. Okay, so that's who's eligible for it. And also you mentioned renter. Now you said renter, basically I can have owned one in the past. And then as long as I haven't owned one in 4 years, then I basically can do it. Now that said, so people don't get confused, you only have 40,000 in lifetime room, right? I can't go doing this twice, like buy a house, use this, buy a house.
One time.
Yeah, one time.
One time per year life. That's correct.
Exactly. So bottom line is you're only getting 40 grand in room total over your lifetime. Okay. So let's also talk about funding this. Okay. So actually, we'll keep staying on the penalty side for this. So let's say I open one of these things up and I'm not eligible. What happens?
Right. So basically, when you're found out, I'm confident you would be found out, the status of that account as being a first home savings account would be revoked back to the date of your account opening. The result of that is that any deduction that you would have received is going to get pulled back. Any income earned in the account is going to get taxed for the year that you earned it. So think of maybe it's a couple of years until you figure out you're going to have to go backwards, report income on prior year returns. There could be some interest and penalties associated with that as well. I haven't seen anywhere where they actually apply a specific penalty other than the change in the taxation. The other thing, we haven't touched on this yet, I'm sure we will, but there's some kind of sideways transfer opportunities between registered accounts. So you can take money that's currently inside your RRSP and move that into your FHSA. You don't get a second deduction for that because you already got one when you first made your RRSP contribution. But it does let you ultimately take the money out of your FHSA tax-free. So for someone who maybe doesn't have a lot of spare cash, that's a way to use this program without making kind of brand new contributions. But the reason I bring this up is in the situation where you shouldn't have opened a FHSA to begin with and the status has been revoked. If you had transferred money from your RSP into your FHSA, they're also going to go back and ding you on that and deem that to be a taxable RRSP withdrawal. So those are kind of the main repercussions there.
And that's punitive, right? So is it a taxable withdrawal in the year you made it, or is it a taxable withdrawal in the year that they discover it?
Pretty sure it's the year that you made it.
Yeah. So I mean, whatever tax savings you had, which is 53% or 50-ish% is $4,000. I mean, these are $8,000 contributions, right? So it won't get that huge, but you get dinged with a $20,000 tax bill because you put money into an account that you shouldn't have, and no one's having a good day that day.
No, that's right.
Good stuff. So
Questrade is the first.
Questrade is the first one to start off for these in Canada.
And out of curiosity, I decided I was going to go through the application process. Now I own a home, so I was never going to actually click that final button to submit it. But I was curious as to what that was going to look like. And I was shocked by the fact that there was nowhere in plain language, in any easy to understand way, where they outlined what the eligibility criteria was. So that, again, Canadian resident, age 18 to 71, first-time home buyer, all they did was in a list of very small print. It was like the second from the bottom bullet point, they referenced a specific part of the Income Tax Act to say, confirm your eligibility. I mean, how many people who's gonna get that far to actually read that? And if they even read it, are people gonna understand what they're looking at? So it was just surprising.
It's not that surprising. I mean, I also hope that some of these institutions, although I doubt it because I know how old their systems are, put in basically bumpers, like don't allow people to make more than an $8,000 contribution, right? That's another concern, right? So bottom line is what you're saying is the first vendor, I'm sure they won't be the only ones who don't take ownership over the due diligence and making sure that you are absolutely eligible and make a caveat emptor. But the reality is that it's going to be very easy to run afoul of this qualification rule if you don't read the small print and you don't know for sure that you're eligible.
Yeah, that's right.
Okay. So, all right. So we cover what happens when it goes wrong. And of course, when it goes right, straightforward. You take it out to basically buy your house. All right. Now let's talk about funding this. I can always make a contribution, but I can also transfer money from an RSP. Is that correct?
That's right. Yeah. So again, if you don't have a bunch of just free cash lying around, but you do have, like, maybe over the prior years, you've just been plowing all your savings into an RRSP, and then all of a sudden there's this new account that you want to take advantage of, but you just don't have the free cash to do it. And maybe you have a home purchase that's on the horizon. Well, now you can basically get money out of your RRSP tax free by going sideways RSP to FHSA and then making a qualified withdrawal that way. So it will help some people, I guess, who maybe don't want to use the home buyer's plan because they don't want the repayments.
Canada's version of the backdoor Roth. Of course, it has to do with housing. So exactly, we'll be able to move that over, which is good. And especially if, for whatever reason, you can't contribute to both throughout the course of the year, contribute to the wrong one, makes a lot of sense. But it's still limited to $8,000 per year, right? I can't just transfer 40 over from my RSP.
Yeah, that's right. And if you do take money out of your RSP to move it over, that doesn't all of a sudden create more RSP room. You kind of had your one shot to put it in your RSP, and that's all you got. Now you can also go the other direction. So if you start with making fresh contributions to your FHSA, ultimately, maybe you just
marry someone who has a house already, right?
Get sour on buying a home, or for whatever reason that home ownership goal doesn't come to fruition. Ultimately, the rules allow you to shift the money into your RSP, kind of a tax neutral basis, and then just leave it in your RSP until years down the road in retirement, it comes out as a regular RSP or RIF withdrawal.
Well, let's also face it. I mean, it's interesting because for someone who's no intention of buying, just being a renter, right? They just been handed $40,000 deductible room now that no one else is getting, that owners don't.
Absolutely. Yeah.
Right? And if anything, I would argue maybe the smarter move for them is to contribute to the FHSA first before an RSP, because the RSP room will carry forward and they could always catch up in the future in lump sums, whereas the $8,000 per year cap is much more limiting.
That's right. Yeah, I would agree with that. That sequence as well.
But I would say that it is unfortunate, though, that going back to your statement earlier about the fact that if I shift money from my RSP to my FHSA, that counts as RSP room, not FHSA room. And if I now take money out, I'm never going to benefit from that increased deduction amount.
Yeah. I think I'm tracking.
Yeah. I mean, I think, if anything, it's unfortunate. Those who don't have the money at a time, who had money earlier, but not now, they basically are going to be denied of $40,000 worth of actual contribution room, which is unfortunate.
Yeah,
but
that's good.
So, there's the thing is that there's a lot more nuance than people are giving credit to this thing, right? I mean,
there's so much nuance. I tell you, there really is.
Well, I mean, we just identified, like, people listening here must have been like, wow, you're kidding me. Like, first off, I could easily screw this up. Maybe I'm eligible, maybe I'm not. People aren't going to tell me I'm not eligible, and I could get penalties for that. And then it all gets reversed and I pay tax. And then if I do an RSP transfer, because maybe that's what I want to do, then I don't get 40, I don't get an additional deduction. I lose that going forward. And so let's also cover what happens if I never buy a house, right? If I never buy a house, how long can this thing stay open?
Right. So you've got 15 years from when you first open the account, well, to the December 31st of that 15th year, I guess. And you have two choices, I guess. One is you can always just, anytime you can take your money back, you can make a withdrawal. And if it's not kind of in combination with the home purchase, it's not going to come out tax-free. It's going to come out as a taxable withdrawal, but you do always have that choice. But if you get to the end of the 15-year timeline and you don't want to take the tax hit by just withdrawing all the money, then you shift it over into your RSP and you push the tax down the road.
Fair enough. Yeah. So, I mean, it becomes effectively, for anyone who's not going to buy, it's effectively a new RSP 40K altogether, really. Now, that's for people who get to that age. The 15-year one's an interesting one because I feel like it's probably enough room for most. I mean, I can already foresee that, and I've already had clients inquire about this, about their kids who are like 18 opening these things up, or going to be 18 opening these things up, which is true and doable, right? Which we'll get into one of the dangers of that in a second. But that gives them until they're about 33, right? There are plenty of people I know who, for various career choices and whatnot, wouldn't buy their house at 33 for the first year. I mean, like, I think of people I know who were in academia, right? Like they basically did undergrad, did their graduate degree, and then basically worked for a little bit, and then went back to do a PhD. And when you're doing a PhD, you're kind of nomadic for a while, right? When you've done a PhD, you're kind of nomadic, trying to find the university is going to take you in for a long period of time. So I feel like we're going to have in 15 years' time a bunch of people who are, not the majority of the population, but a segment. We're going to be forced to make that decision because, hey, the clock's run out.
Yeah, and I would say that's even more true in your neck of the woods or Vancouver, Victoria areas than in Calgary, where I am, just because of general affordability.
Absolutely. Absolutely. I mean, yeah. So even if they're not, even if they're just like average to low income earners in their career choice, right? Like building up to buy that.
It's just going to take a while.
So, and what happens, I mean, if they basically miss that 15-year cutoff, it'll probably lead to deregistration and a full taxation of that amount.
Yeah, exactly. Or I guess you could look at, again, going into your RSP and then just deferring that tax. And then maybe, I guess the saving grace is that as of now, you can still participate in the home buyer plan.
Yeah, you can do both. And that's a $35,000 loan from your house that you have to pay back over 15 years, from your RSP. But I mean, that's assuming that people catch the fact that the 15-year clock ran out, right? Like the question is, how much leeway and grace are they going to be given? This is really what I wonder about. I mean, it's a problem for 15 years from now, but nevertheless. Now, let's talk about, I said there's reasons maybe why you wouldn't want to give an 18-year-old $8,000 a year into an account. I don't know about you, but I'm not big in putting money in the hands of young adults until they've proven that they can handle it. Yeah, I'm curious. Do you have any horror stories of kids in trust for accounts going sideways?
Not yet. Luckily enough, it hasn't come across my desk, but I know there's plenty of risks there. Yeah, I haven't had any 18-year-olds demanding access to money in trust for accounts or anything like that up until now.
Neither have I, but I've seen it happen elsewhere, at least on my practice. But so just where we're alluding to is, the end of the day, you give your kids money to put in that account.
It's theirs.
It's theirs. And in addition to that, I know people say, well, yeah, but it's with my advisor. Your advisor can't legally tell you about it after 18. If they do, that's a privacy violation, and your kids got their head. And that's the reality of it. And so it's theirs. I always say, never put a penny in their hands until you're ready to see it disappear.
Yeah, that's a very good point.
Yeah. So what other nuances or concerns should people be aware of and worried about?
So one thing, just timing is pretty important when you actually do buy your house. So you can make a withdrawal so long as you have a purchase agreement to close on a home, and they give you a lot of lead time here. They give you until October of the next year. So in theory, you could be January 2024 with a closing date of September 2025, and I've never seen a purchase agreement that extends that far, but that's the possibilities that we're talking about. But on the side where you could maybe make a mistake is if you are rushing and it's a quick sale and you get possession and the funding of it is maybe an afterthought, like you got other sources. If you wait longer than 30 days after you've closed, you're no longer eligible for a tax-free withdrawal. So there's a lot of stuff going on in your life in those moments. I mean, geez, you're working with a mortgage broker. Lots of people know how stressful that can be. Movers, packing up all your stuff, getting new place rekeyed. I mean, there's so much going on. If you weren't strictly relying on this money for a down payment or something, it might just slip through the cracks. And then you're more than 30 days after, and you've lost your opportunity. Like that's one that I think will happen to people, and it's going to be rough.
Well, yeah, exactly. I mean, the timing, because I mean, you might not be looking for that money to be used specifically for the down payment, right? It's simply all the additional costs that go with it, right? To renovate something, to buy furniture. Moving is my single least favorite thing in the world to do. And I got to tell you that is very easy to slip by 30 days, like very easy.
30 days flies.
It's a difficult one. It's a difficult one. So
another nuance is just on the estate side. So you can name a beneficiary, successor holder. So successor holder can only be your spouse or common law, but and that's probably what you want to do, so that if you pass, then your spouse assumes the account as an FHSA rather than just liquidating the account and getting the money. But on the beneficiary side, this is really interesting. Very surprising that they set this up. Most people are familiar with how beneficiaries work with RRSPs. So if it's not your spouse, you name beneficiary, they get the full market value of the account, and the tax is dealt with by the deceased on the deceased final tax return. So there's a mismatch of the money goes one way, the tax goes the other way.
This happens all the time when people leave an RSP behind to one kid and something else to another kid, and now they think it was like they were both worth $250. Because now the estate that other kid has to clear has the tax bill for that one kid's $250. So
if you name someone who's not your spouse as the beneficiary of your FHSA, they get the money, but they pay the tax too. The tax leaves the original account holder not dealt with in the final tax return of the deceased, the tax is paid by the beneficiary. So it's kind of the opposite tax treatment here. I think that's going to throw people for a loop when they're doing their
weird one, because it could very well be that the tax situation is worse, right? It could very well be that someone, God forbid, a young adult basically who's got this in there leaves it to their parents in prime earning years, and now suddenly the tax bill on the estate would have been 20%, and it gets taxed at 53 or 50, 55, whatever province they're in. That is, I mean, from an admin standpoint, I kind of get it being a little bit easier, and it'll prevent, you just traded one estate problem for a different type of estate problem.
But now you have to consider which way is which. So it's one of those things, it's a wrinkle.
Well, it's interesting because if you then in turn just default to the estate, then suddenly you're back to the original treatment of an RSP, and it's got to be probated, sure. But at the same time, now it might be a tax advantage to leave it to your estate, which is a weird one to say.
Mm-hmm. That's right.
Yeah, no, there's a bunch of wrinkles to this, and it's still new, and probably see some legislative changes when some of these realities start to come to bear. So yeah. So any last thoughts that big things we should be aware of?
Well, how nitty gritty into like weird stuff do you want to get?
Let's get weird.
Okay. So there's just some situational things you could look at. Like you could even look at this account from an income splitting standpoint. There's really no attribution. So if you gift your lower income spouse money, they invested in their FHSA, ultimately it could come out tax-free if you buy a house, but if you don't and it's taxable, it's taxed to them. All of their income earnings over that period of time
goes back to the original contributing spouse.
Yeah, there is no tax attribution. So you can kind of just
it's the spouse who owns it, not the contributor?
Yeah, there is no attribution here.
So that's interesting, because normally other situations it would go back to the contributing spouse. So your non-income earning spouse, in theory, I mean, it's an edge case because like odds are you're probably going to use the place, buy a place. Correct. But if not, then you just found a way to move from high income, high tax to no tax.
Correct. Yeah. For older people too, if you went, say you're 65, between 65 and 70, if I put money in my FHSA, I'd have that option to roll it over into a RIF. If I'm 65 and over, I make a withdrawal from my RIF. All of a sudden, 50% of that withdrawal becomes eligible for income splitting. So again, there's $40,000 over 5 years that you could look at splitting. So you kind of you get the deduction for $40,000. Your spouse ends up taking half of that as income when it's withdrawn. So again, there's a couple. They're edge cases, but there's some income splitting opportunity here, depending on how important that is to your situation. And yeah, so this is just a weird one. I was talking to someone on Twitter about this today, actually. But the way that they've set this up is the only times that really matter for you to be a first-time home buyer is one, when you open the account. So you have to be a first-time home buyer when you open the account. The only other time that it makes a difference is when you try and make a tax-free qualifying withdrawal. Okay, so let's just think about that. If you are 2 years into this and you buy a home, but you don't do the tax-free withdrawal, you can keep your FHSA account open, continue to make further contributions even after you become a homeowner, and then eventually you move it into your RRSP, right? So it's like weird that they've allowed for this.
I got one. Another one for you, right? So first off, again, that is a loophole that needs to be closed down, right? It should be based on the contribution. Now, here's the other piece of this. In theory, you could buy a place, keep the account, sell the place, wait 4 years, buy another place, and then make the withdrawal. Now, I mean, that sounds a little bit farcical, but let's not forget that some people get relocated a lot for work, right? And maybe they're, in some cases, look at some members of my own family who basically got moved to the U.S. for a period of time, and wouldn't count for the U.S., but got moved someplace for a period of time. Company was willing to basically put a floor into the value of their home for sale and pay for all the moving costs because they were an executive. So, and they weren't sure how long they were going to be there. But in theory, in a situation like that, it would basically work out fine, right? Like they would be able to, this is not going to be our forever home. We plan on moving back to wherever it is. They'd be able to use it. So that one's less of a loophole, right? It's more so the continued contributions while you're there. That is a big loophole.
Yeah, and I've looked, I haven't seen a single thing that would restrict you from doing that. So just really peculiar.
That's going to be a tax omission at some point. So yeah, that is a peculiar one.
Mm-hmm. The other thing, I was talking to you offline a couple of days ago. and you called me a money launderer because I thought of this idea where if you had money in your it's like, how do you get a double deduction?
Yes.
So you get a deduction when you make an RRSP contribution. And then on the same money, you could, in theory, withdraw it through the home buyer's plan. It's in your bank account. Then you take that money, deposit it into your FHSA, get a second deduction, and then withdraw it through the FHSA program tax-free. 2 deductions on the same money. You could then take that money, pay off your home buyer's plan if you wanted to. I mean, it's kind of a weird one.
It's a weird one. I mean, like, here's the thing. These are edge cases. And the reality is the vast majority of people are going to use it for the intended cause. I do believe that the contribution loophole is a weird one that really needs to be closed. But otherwise, everything else, I think, is a bit of inherent flexibility to it. Let's also discuss one last topic before we finish up. And that's what happens to American citizens. One of my favorite topics, who open these things. Sorry, people.
So no deduction. I can't see you getting a deduction.
On your U.S. tax return. Yeah.
No chance on your U.S. taxes. I would expect you have to be careful what you invest in. So PFICs likely to be an issue would be my guess.
Same rules with non-registered account with taxable accounts.
Yeah. They're not going to consider this in the same way that they do as an RRSP. That's going to take it'll take like 25, 30 years for them to recognize it. So that'd be the main thing, I guess. If you expatriate and you leave Canada, you're no longer a resident, make a withdrawal, you're going to have your non-resident withholding tax issues. Maybe not issues.
Income every year too will be taxable, right? And then it'll likely require trust filing. So now we're back in
it's like a TFSA.
It's like a TFSA. Now, that's not to say you shouldn't use it, right? Like, and I've published on this before. Look, it's a cost benefit, right? Like, it's going to cost you a couple $100 to file a return. It's not taxable in the US, but it's not taxable in Canada, but it is taxable in the US. But odds are you probably already have enough foreign tax credits, so you're not going to pay a penny on it. So it's really the filing fee is the big issue. Now, a filing fee on an $8,000 account of $200 is a pretty substantial incremental cost. On $40,000, it's still a pretty substantial incremental cost, right? So I don't know that it makes sense for anyone who's looking to buy in the short term, because
I would totally agree with that.
Yeah. Well, let me reframe that. High income earners looking to buy in the short term probably does make sense because of the deduction versus the carrying cost. People near the lower bracket makes absolutely no sense because they'll probably save as much in tax as they do in carrying cost.
Yeah. Maybe there's some math merits if you were thinking about holding it for 15 years at the 40,000 level, but I don't know. It's a complication.
I mean, like, we don't even open up our TFSAs for clients until they're probably well north of 50,000 in room, because the math almost good cost. And it's like, well, we're not going to add an MER. I always say it's like adding another management expense ratio with kind of a couple percentage points on it. Not worth it.
No, that's right.
Yep. So, Aaron, thank you so much for your time. I appreciate this. Where can people find you if they want to learn more about your stuff?
You can follow me on Twitter, Aaron Hector CFP. I'm on LinkedIn. My corporate website has my bio too, CWB Wealth.
Excellent. And just like myself, Aaron does his best damage on Twitter. Anyway, thank you so much for your time.
Yeah, thanks, Jason. Cheers.
So that was today's episode of Financial Planning for Canadian Business Owners. Hope you enjoy that. And I hope you understand that this very simple looking account actually has a lot of complexities. It's very easy to go sideways. So use it when you qualify. Be careful with it when you are looking to take money out. Make sure you do it right. Get the right advice. And I will unfortunately say in this case, the right advice is going to be hard to find right now because it's so brand new, but give it time. By the time you probably if you start one today and looking to buy in a few years, I'm sure we'll work out these bugs, but be careful. As always, if you enjoyed this podcast, please review on Apple Podcasts, SoundCloud, Stitcher, Spotify, or wherever you get your podcast. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals, business owners, and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on Apple Podcast, Stitcher, Google Play, and Spotify, or find more episodes at jasonpereira.ca. You can even ask Siri, Alexa, or Google Home to